2026 tax brackets changed. What high-income retirees need to know. Before we start, you may see a few ads. Thank you for letting them play, so I can keep bringing you free, actionable advice. Now let's continue. Imagine for a moment that you have worked 40 years to build a 7-figure nest egg, only to realize that the government has a silent lien on nearly 40% of it. Most high earners believe that once they reach retirement, their tax burden naturally vanishes. But for those with significant traditional IRAs, 401k, and appreciated taxable brokerage accounts, the reality is a looming fiscal cliff. We are entering a period of unprecedented volatility in the tax code, where the rules you played by for decades are being rewritten in real time. If you are sitting on a substantial portfolio, the difference between proactive capital allocation and passive waiting could literally cost you hundreds of thousands of dollars in unnecessary taxation. There is a hidden math at play here, and if you do not understand how the Internal Revenue Service views your distributions, you are essentially leaving your legacy to chance. The landscape has shifted dramatically. While many expected a massive tax spike due to the sunsetting of previous legislation, a new set of rules has emerged that creates both massive opportunities and dangerous pitfalls for the unwary. We are seeing a fundamental restructuring of how the federal government views high-income retirees, business owners, and professionals. The thresholds for the top marginal brackets have been adjusted, but more importantly, the underlying mechanics of deductions and credits have been overhauled. For those of you with a modified adjusted gross income that puts you in the top tiers, the stakes have never been higher. We are talking about the potential for higher Medicare surcharges, the phase-out of key exemptions, and a complete revaluation of estate planning thresholds. Let us pull back the curtain on what is actually happening with the new tax brackets. For a married couple filing jointly, the top 37% rate now kicks in once your taxable income surpasses $768,700. While that sounds like a high bar, remember that for a high net worth retiree, taxable income is not just a paycheck. It is the sum of your required minimum distributions, your Social Security benefits, your dividend income, and any capital gains you realize to fund your lifestyle. If you are not careful, a single large withdrawal to purchase a second home or fund a family milestone could push your effective tax rate into a territory you haven't seen since your peak earning years. To navigate this, we need to move beyond basic retail financial advice and look at institutional-level capital allocation. The first principle you must master is the strategic use of the new senior deductions. There is a fresh $6,000 deduction for individuals over 65 or $12,000 for married couples, but it comes with an aggressive phase-out. If your income exceeds $150,000 on a joint return, this benefit begins to disappear at a rate of 6 cents for every dollar over that limit. This is a classic example of the shadow tax. It is not a rate increase on paper, but it is an increase in your actual tax liability. To solve this, you must look at your portfolio's liquidity management. Are you pulling from the right buckets at the right time? This brings us to the second principle, which is the optimization of the state and local tax deduction, often called the SALT cap. For years, this was capped at a measly $10,000, which penalized retirees in high-tax states like New York, California, or New Jersey. The cap has now been raised to $40,000. This is a massive win for property owners and those with high state income tax, but it is a temporary window. If you are a business owner, you should be looking at pass-through entity elections to potentially bypass these limits entirely. This is a sophisticated move that allows the business to pay the state tax at the entity level, effectively turning a capped personal deduction into a fully deductible business expense. The third principle is perhaps the most critical for long-term wealth preservation, and that is aggressive tax loss harvesting and strategic rebalancing. In a high RPM environment, your goal is to minimize realized gains while maximizing the step-up in basis for your heirs. If you have concentrated stock positions, you should be looking at direct indexing or exchange funds to manage that risk without triggering a massive capital gains event. Remember, the net investment income tax is still a factor, adding an extra 3.8% on top of your capital gains if your income is high enough. By pairing your gains with realized losses, you are not just saving on taxes today, you are performing essential liquidity management that keeps your capital working for you rather than the Treasury. For those of you focused on estate planning, the rules around the lifetime exclusion are also in a state of flux. While the exclusion remains high, currently around $15 million per person, the clock is ticking on how long these generous limits will last. If you are an investor with a significant estate, you cannot afford to wait until the laws revert to older, more restrictive levels. You need to be considering irrevocable trusts, family-limited partnerships, and charitable lead trusts now. These are not just tools for the ultra-wealthy. They are essential components of a fiduciary-focused plan for anyone who wants to ensure their capital allocation aligns with their family's long-term security. Let us look at a real-world example. Imagine a retired couple, both 68, with a $4 million traditional IRA and a $2 million taxable brokerage account. Under the old rules, they might just take their distributions as needed. But under the new 2026 framework, that is a recipe for disaster. By utilizing Roth conversions now, while they can still stay within the lower 22 or 24% brackets, they are effectively locking in a lower tax rate today to avoid the massive required minimum distributions that will hit them later. They are also protecting their heirs from the 10-year rule on inherited IRAs, which often forces children to take huge distributions during their own peak earning years, leading to a massive tax hit for the family. So, what are the specific, implementable steps you should take right now? First, perform a comprehensive tax projection for the upcoming year. Do not wait until April. You need to know exactly where your modified adjusted gross income will land so you can manage the phase-outs of the senior deduction and avoid unnecessary Medicare Part B and Part D surcharges. These surcharges, known as IRMA, can add thousands of dollars to your annual healthcare costs if you tip even $1 over certain income thresholds. Second, review your charitable giving strategy. With the new rules, there is a permanent $1,000 above-the-line deduction for charitable contributions for singles and $2,000 for married couples. This means you get the deduction even if you do not itemize. However, if you are over 70 and a half, the qualified charitable distribution remains the gold standard. You can send up to $105,000 directly from your IRA to a charity. This counts toward your required minimum distribution, but is excluded from your adjusted gross income. It is the single most efficient way to give while lowering your tax profile. Third, if you are still working or consulting, maximize your retirement plan contributions. For 2026, the limits have increased to $24,500, with an $8,000 catch-up for those over 50. If you are in that sweet spot between 60 and 63, the super catch-up allows for over $11,000 in extra contributions. This is a prime opportunity to shift high-tax ordinary income into tax-deferred or tax-free growth. Finally, audit your investment portfolio for tax efficiency. Ensure that your high dividend and high turnover assets are held in tax-advantaged accounts, while your long-term growth assets and municipal bonds are in taxable accounts. This simple act of asset location can add significant basis points to your after-tax return without increasing your risk profile. In summary, the 2026 tax changes are not just a collection of new numbers. They represent a fundamental shift in the American tax landscape. For high-income retirees and business owners, the goal is no longer just tax preparation. It is strategic wealth management. You must balance your need for current income with the long-term preservation of your capital. By understanding the interaction between marginal brackets, deduction phase-outs, and institutional capital allocation, you can move from a position of concern to one of confidence. If you found this breakdown valuable, please click the thumbs up button to give us a like as a thank you for this content. We upload fresh videos on these high-stakes financial subjects regularly, so make sure to subscribe so as not to miss our next deep dive into wealth preservation and tax optimization. I would love to hear from you in the comments. Share an idea from the video that surprised you, or let me know what specific tax or retirement concerns you are facing in this new environment. Your questions help shape our future content to ensure we are delivering the most relevant institutional-grade advice. As a final reminder, I am not your financial advisor. The information provided in this video is for educational purposes only and does not constitute professional tax, legal, or investment advice. Every financial situation is unique, and you should seek the counsel of a qualified fiduciary or tax professional before making any significant changes to your financial plan. Thank you for watching, and I look forward to seeing you in the next one.